Hi, this is David Duty with Common Sense Commodities in Boquete, Panama. And in this short video, I wanted to discuss a little bit about where to start in options trading. I just did an article and put it on the website. These charts were in that article, and I want to do a video that kind of goes along with it. As you can see back here, we're looking at feeder cattle, or I'm sorry, live cattle. And if you were thinking about shorting this market, you could have shorted it to break below the prior day's low. You could have had a target that would have come down, down into this area here. Would have given you a $3,250 profit. Now, if you'd have put a stop up, above the recent highs, that would have been about almost a $2,000 stop, 1989. Could have been a little bit lower if you wanted to drop it down some. But it's still $1,700, $1,800, $1,900 in risk. Now then, I wanted to talk a little bit about puts and doing a call along with a put. If you decided to short this market, like I said, you could have done it with a futures contract. Reward would have met 3,200, risk could have been about 1,900, or at least that's what I showed in the article that I wrote. All right. Now then, if you had bought a 125 put at 275, it would have cost you uh, $1,030. So let's say that you did that. Now, to help offset that, let's say you don't want to take that much risk on this. You could have sold a call. You could have sold a 132 call and received $630 in profits. Now, when you expect the market to go down, there's two different things you can do. You can buy a put, and if the market goes down, the put will usually increase in value. Or you can sell a call, and if the market goes down, the call will decrease in value, which is a profit for you because you received the premium on it. Now in this example, I'm going to show you the difference between a short futures contract versus buying a put and selling a call at the same time. Now the reason that I would sell that call is to help pay for the put. Because right now, as you can see, that put, a 125 put, is out of the money. It cost $1,030. All right, so that's what I would have to pay to buy that put. Now then, if I were to sell this 132 call up here, I would have received $630 in premium. So that $630 goes into my account, which will help me pay for the $1,030 that I paid for the put. So my net cost on that option would be 500 bucks. So if the market goes down, all right, I'm going to make money on the put, and I'm also going to make money on the call because the call that I sold will decrease in value. All right, so I'm making it on both sides. Now, obviously, the downside of that is if the price goes up, I would lose money on the put that I purchased, and I would lose money on the call that I sold because if the market goes up, the call that I sold would go up in value. So I'd lose it on both sides. However, on the future side, I'd be taking approximately $1,900 in risk. All right. Now then, I can kind of control the risk on the options because I can say, okay, I'm looking at $1,900 in risk on a short futures position, and I'm going to put the option trade on instead. And if I lose $1,900 on the options, I'm going to get out. So I'm not going to take any more money on the option side than I will on the future side. Now, obviously, on either one, the options or the future side, you could get out anytime you wanted to. You don't have to wait, and take the full hit. Just using it as an example. All right, now let's play this forward a little bit because I've already got some text over here that I used in the article that I wrote. All right, and I don't want to, delete those. So I'm going to move it forward one day at a time, and you can see that I was filled. Now look over here because I don't have a short futures on the chart. I've only got the options on. So you can see that the first day, the options are up 420 bucks, right? It says total open profit and loss 420 bucks. And the only thing I've got on right now are those two options, right? Now the futures would have been up a little bit more probably. Let's say that I got in here, price ended up here. That'd have been up about 400 bucks. But my risk to do that initially was, we're going to call it 1900. So on that $1,900 risk, I'd be up 400 bucks, about 20% or something, right? Now then, out of the cost of putting on the options, that actually cost me about 500 bucks. And the reason it cost me 500 is because I bought one of the puts, and that put I paid 1,100 for. What was it? And I sold the call for 600. My net cost on the option side was about 500 bucks. Wasn't that much. But as you can see, I've made, the first day, I made $420 by taking a risk of 500. I don't have I'm not going to put the calculator up, but to me that looks pretty darn good. Looks like a 90% return or something in a day. All right, let's play it forward today. All right. By the way, 1900 versus 400. You know, I'm looking at 20%, 25%, or whatever it would have been as far as a gain on my risk on the future side. Let's play it forward another day here and see what happens here. Now you can see that I'm up $670 on the options, and on the futures I would have been up about $870 approximately. Let's call it, it's not that much. Let's call it, let's call it 890. So I would be up 890 on a $1,900 risk. Now on the futures, I took a $500 risk, and as you can see, I'm up 670. So which is better? Being up $670 on a $500 risk, or being up $900 on an $1,800 risk? Now it doesn't take a rocket scientist to figure out that the options are a better profit-making tool on this particular situation. Let's continue to play it forward a little bit. All right. Now here, you can see that the options are now worth $590, and I would have made, so let's see here, I made $590 on those, which is still 100% return. And I made $720 on a $1,900 risk. We're going to call it 1,900 even though that's hard. $1,900 risk. I've made $720, 33% or 35% or whatever that scenario. Still doing better on the options, right? Still doing better on the options, still doing better on the options. Now we've got a big drop. Now then, I've made $1,230 on the options. Now my risk on that was $500, right? So I've got a $500 risk. Let me pull this over here. I've got a $500 risk and a $1,230 profit divided by 500. I've got almost a 2.5 times, 246% return on the options. Now, to be fair, let's look and see what kind of return we would have had on the futures. Let me pull this down. So remember, 250% return on the options. Here we've got 1620, and we were risking 1590. So we've got 1620 divided by 9. Let's call it 1900. So I've made 85%. So on the future side, I made 85%. On the option side, I've made 250%. So it doesn't take a rocket scientist to figure out that 250% return in approximately 1, 2, 3, 4, 5 days is better return on the options here than we made on the futures contract. All right. So anyway, there's going to be a lot of different articles at the website. I'm going to have a lot of different articles here on YouTube. If these are helpful to you, please click the like button below, share those, make some comments. I'll reply to the comments when I see them. Or you can also send me an email at david@davidduty.com. Here's the website, commonsensecommodities.com. There's lots of different articles that you can find over there, some videos like this, and also subscribe to the YouTube channel because I'm going to have hundreds of different videos up here, during the year, and you'll get to watch those as well. So anyway, I appreciate your time. If you have any questions, let me know. Either send me an email or put something in the chat below and I'll respond to it. Take care. Have a great day. Bye-bye.